but we will continue our coverage here on the BOJ and bring in our next guest because he'll give us more context about where the markets could go from here. Jesper Koll, expert director at Monex Group, is here with me right now. And Jesper, you're smiling and laughing next to me. Thanks for coming in to break down the decision for us. As expected, give us your reaction.
Look, as expected, yes, but I think that we're starting to walk a fine line with the Bank of Japan running greater risk now of doing too little too late. And first of all, the Bank of Japan is very clear that they want to normalize monetary policy. They want to normalize Japanese debt markets. Fine. But they also tell us that they need to see evidence that the economy remains on track. Now, every evidence that we've gotten, whether it was capital expenditure, even GDP, the corporate metabolism, if you look at M&A activity, MBO activity, overall, the economy is well on track. And then you got a fiscal stimulus package from, yes, a lame duck government, but fiscal supply is going to continue to support the economy. So when does the Bank of Japan start to lose credibility that, maybe the economy is not as strong? We still don't have confidence. Well, dear Bank of Japan, if you don't have confidence in the Japanese economy, why should global investors have confidence?
You mentioned the political infighting right now on the backdrop, right? The stimulus package. Some people were saying, yes, it's not something that the BOJ can comment on, but that is going to hang over their heads. I mean, remember what happened in July when they surprised and all politicians came out talking about the yen?
But look, whether politicians talk about the yen, because ultimately they can't get anything done in parliament, right? Of course you talk about the central bank. The key point is the Japanese corporate sector is very strong. You do see at the same time, yes, bad inflation because of yen weakness reducing the purchasing power of Mr. and Mrs. Watanabe. And people forget, you've got basically 1 in 3 Japanese living off a pension. And if you're a pensioner, whether the shunto goes up, whether the Nikkei goes up, doesn't matter. What matters is, yes, thank you, prices going up, reducing the purchasing power of the people. That's a problem. And that's ultimately the Bank of Japan's, independence at work to actually say, hey, it's not just bad inflation, but there's also inflation that now needs to start to be curtailed.
Was this miscommunication then leading up to this decision? Because the markets were not pricing in any move this time around. If they had come out and surprised, that could have been worse for the financial markets as well.
I actually think it's just a weak policy board. You've obviously got a brilliant, my former professor, you've got, a brilliant governor in Mr. Ueda, but you've got a board that I think is not very, very decisive. And as a result of that is easily swayed by whether it's politics or whether it's financial markets. And I worry a little bit when we look into 2025, because we know that, whether it is the new Scott Bessent, the new U.S. Treasury Secretary, whether it is obviously Donald Trump. I mean, these guys are hyper charged in making fast decisions, decisive decisions, big decisions. And if Japan continues to waver, again, from a market, from an investor perspective, why do I bother when there's all this decisiveness happening in the United States? Why should I bother with Japan?
And if you look at the economic fundamentals as well, some people were saying perhaps that is one of the reasons that we are not seeing Japan as in such a strong footing if you're talking about services inflation, if you're talking about wage growth. Compared to the United States, perhaps the economy here in Japan, despite the headline numbers, under the hood, is it more sluggish?
I disagree with this in the sense of that, look, Japan will always be, for the next decades, a low-growth economy. It's just the nature of aging. But as an investor, what I care about is corporate metabolism. Do corporations, actually engage to improve, number one, the capital structure, reduce those lazy balance sheets. Number two, improve the industrial structure. And there's plenty of exciting stuff going on at the micro level, at the company level. I mean, look at Seven & I, right? This battle, fantastic. And you know what's great about that battle? The banks are prepared to lend. You know, if the Ito family wants to build a consortium as a white knight, the banks are going to lend. First time, I mean, you weren't even born when Japanese banks were ready to lend.
Let's not go there. But I do get your point about that corporate activity that we're seeing here. CEOs wanting to talk, wanting to restructure their companies. Could that be what's attractive, despite what the BOJ is doing?
But look, that's exactly what's attractive. But the point being, for stock pickers, Japan is a heaven right now because there's all this corporate activity, right? The market for corporate activism. I mean, Bloomberg wrote a nice story about this, right? The market for corporate activism now in Japan is second only to the United States of America. Lots of individual stock picking opportunities, a heaven for that. But at the macroeconomic levels, when I talk to global asset allocators, right, they say, well, we come to Tokyo and, you know, we meet with the Bank of Japan, we meet with the Ministry of Finance, and everybody is very cautious. If everybody is very cautious, while I go to the United States in particular, right, you know, where everybody is optimistic and gung-ho to actually get things done, this is the contrast. So you get the stock pickers, but the big asset allocation shift, let's make a big bet on Japan, that isn't happening. And one of the reasons for why it isn't happening, like the BOJ decision today, the leadership here in Japan is still way too cautious.
Could it even get more cautious given the political infighting that we're seeing right now, given the weakness of the Ishiba government after the October elections? I think that was a big question mark right now about decisive policies being pushed.
But look, it's interesting, right? Because, I mean, you know, what happened, you know, as a result of the, you know, Ishiba weakness, right, is that you actually get the wrong kind of policies, right, being, you know, extended further, specifically, you know, support for zombie companies, right? I mean, again, what I want to see is I want to see exit, right? I want to see, you know, some of the marginal companies that can't meet their cost of capital. You know, you want to see those companies fall by the wayside. You want to see that consolidation. But here we get a weakened LDP, and the first thing Mr. Ishihara does is extend 33 trillion yen of loan guarantees. That's you and I, the taxpayer, supporting a zombie company that ultimately is there to actually cannibalize profitability for the profitable firms.
So what happens then in 2025? Say right now the signaling from the BOJ is that they might hike in January. It seems to be what markets are pricing in.
But look, my view is very simple. I think you and I will meet this time next year, and the Japanese policy rate is going to be at 1.25% to 1.5%. I do think that we will see a shockingly strong shunto, because if you look at the labor market, every CEO I talk to, the number one, number two, number three problem they have is hitode busoku. It's like, I can't find talent.
People.
There's not enough people. And when you look at the data, it's fascinating, because now the mobility of labor is actually accelerating very fast. This is the first year where the top 400 companies in Japan, right, hire twice as many people mid-career as they do graduate intake. Normally it was always graduate intake. Nobody in Japan jumped jobs. Nobody in Japan, right, you know, was hired mid-career.
Employment for life.
And you know what's cool? When you look at the wage data, right, the people in their 20s and 30s, they actually see when they jump jobs, their pay goes up by 40%.
Oh.
And that's not captured in the wage data. So you and I want to be reborn as a 23-year-old Japanese, because the job opportunities are there. The increase in pay is very, very substantial. And that's, you know, what's going to drive, you know, the overall metabolism, positive metabolism, you know, of the younger generation in Japan.
And yet, if you have these companies paying more for all of these workers, doesn't that pressure their margins as well?
No. Because the way I get paid in Japan, which is basically the same as everywhere else, actually, you know, you get paid, you know, more as you get older. And, you know, the fact that the baby boom generation is rolling off, right, gives you actually significant cost savings. Let me give you a concrete example. Japan's largest telecommunications companies, I'm sorry, I can't mention names, individual security. Japan's largest telecommunication company, right, over the next 3 years will see a 15% reduction in labor costs just because of attrition, because of the baby boom generation retiring. So they've got lots of room to actually increase increase wages for the younger people. Remember, if I'm in my 30s and I work for a big Japanese company, my pay relative to somebody who is 55, right, is basically about 50% lower. So the cost savings, I can actually afford, right, to hire young people at a higher pay. Mr. Yanai, and now I do mention a company of fast retailing because that's public information, right? Last year, remember, increased starting salaries by 40%. This year, starting salaries in aggregate have increased by 18%. And trust me, next year, they'll be increasing by 20%.
Which takes us back to the fundamental issue of demographics. Where will all of these young people, the companies want to hire, come from?
Yeah. So, number one, they will come at a higher cost. Number two, they will come from competitors where the CEO, right, is actually sleepy and thinks he can stick with the old way of doing things. I think a big theme for investors in Japan is actually, charisma CEO, somebody who jumps out of the salaryman shacho, salaryman CEO mode, is prepared to break away with the proud Japanese culture of lifetime employment and seniority-based pay, and somebody who is actually prepared to switch to merit-based compensation. I urge all investors who come to Japan right now, meet with the CFO, meet with the CEO, but do meet with the head of HR, because you need to see that the incentives, the stick and the carrot within companies is moving towards meritocracy.
I don't know, Jesper. I mean, I lived in Japan more than a decade ago, and I come back, and yes, there is more motivation. CEOs are more open. They want to speak. They want to speak to foreign media. But at the same time, the changes have been very, very gradual. You've been here for decades. Is this time different?
Look, this is Japan. Japan runs marathon. Everything is kaizen, not kaikaku. Everything is gradual, incremental improvement rather than dramatic reform. However, right, just look at the reality. And you see that some of the leading companies now are implementing merit-based compensation, a huge break. Do you know that also on the topic of immigration, right? You're not allowed to talk about this, but just look at the data. Over the last 18 months, right? The Japanese population every day declines by 2,200 people, but over the same last 18 months, every day, 1,200 non-Japanese get a work permit. Now, from an economic perspective, what's more important? This part, the dying part, or the fact that you've got young people coming in who are productive, who are knowledgeable of using AI, for example, right? So that's where I think it gets very, very exciting. Yes, it's incremental change, but, it is very, very wrong, in my opinion, and particularly, again, from the Bank of Japan, just to be a little bit critical here, right? You can wait and be uncertain about a lot of things, right? But the reality of a virtuous cycle having started. And look at the financials. Look at the financials. I mean, the huge benefit that they already got from the Bank of Japan reprivatizing Japanese debt and money markets. The BOJ is no longer hoovering up, all the debt securities that are out there. Now the Japanese banks, the Japanese insurance companies can do that and actually start to make a little money. That's a virtuous cycle.
I gotta say, when it comes to immigration, I have seen the changes. Just walking around Tokyo, you are actually seeing more foreign workers in convenience stores in every part of society these days. But I gotta ask you, what happens in 2025, especially with the uncertainty of an incoming Trump administration and potentially global tariffs?
But look, I mean, this is all, par for the course. The nice thing is everybody's worried about Donald Trump and the huge uncertainties. I'm like, what's uncertain about the whole thing? This is a pro-business, a radical pro-business administration. Scott Bessent is very clear in his 3-3-3, right, that America wants 3% growth, 3% interest rates, and 3 billion barrels of oil. You will see, a very decisive America, and the question is whether Japan's ruling elite, and that includes the Bank of Japan, is actually going to just sit and wait and watch, or whether the Japanese ruling elite is actually going to start to make decisions like, for example, Masayoshi Son just did.
Oh, wow, right?
And there he goes, and it's $100 billion of investment. Now, how he's going to come up with the money, well, that's Masa's continual issue. But, you wouldn't want to bet against that. And the determination is, I think, very, very real.
I want to talk to you more about the currency, especially if it gets on the crossfires of the Trump administration. I have heard President Trump recently talk about the weakness of the yen. So do stick around. Jesper, Koll, expert director of Monex Group, is staying with us for more analysis on Japan, of course, later in the show. But first, let's get to Avril Hong for a closer look at the yen. Avril.
Yeah, we're seeing dollar yen really pop, right? It acted as expected, but still that reaction in the markets. And I think, forget about 155, 160, I think is what traders are looking at next, really heightening the risk of intervention. For dollar yen to be talked down, Ueda now really has to communicate very clearly that they're going to hike in January, and not just that, not just a one and done. That's going to follow through with a March and a May move as well, in order for, a bit of yen strength to seep back into the markets. And of course, this is all coming against the backdrop of that frustration, I suppose, for yen bulls, because if you look at the wage and the inflation data in Japan, that backs the case. You know this, Sherry, part of why it didn't move today was the fear of domestic political backlash, but also, I guess, partly to do with what we're seeing in the Fed and the market reaction. Perhaps that made it more difficult for the BOJ to hike this time around. Nikkei futures not really budging from where we saw it just before the decision, but take a look as well at how the Japanese currency is faring against all its other G10 peers. It's actually losing ground against all the G10s today. It's also against the backdrop of how there are these vanishing rate cut bets, not just at the Fed, but also at the Bank of England. You think about how it's likely to skip that rate cut later today amid those inflation fears, that UK CPI that shot up to 8-month highs, really the concerns about stagflation in the country. We're seeing the pound yen at 1955 now, Sherry.
Avril, great insight into the markets and the yen, and you can also turn to your Bloomberg, of course. TLIV Go is a function for you to follow the commentary and analysis from Bloomberg's expert editors. This is Bloomberg.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut.
Fed Chair Jerome Powell speaking after today's 25 basis point rate cut. More now on the Fed decision, with officials signaling greater caution over how quickly they can keep easing next year. Bloomberg's Asia economics correspondent Katya Dmitrieva joins us now. And Katya, of course, we had the market reaction, the worst Fed day since 2001. It was this signaling that was an issue for the markets.
Yeah, we heard from Powell there. It's probably the clearest we've heard yet from the Fed that inflation is just not heading in the direction they want fast enough. And it was said in a variety of ways. So you heard Powell in that press conference there. We also saw the dot plot, the so-called dot plot of projections for rate moves, moving down to the equivalent of about 2 rate cuts. Now, previously, even just a few months ago, Fed officials saw 3. Analysts broadly expected 3 cuts, so that was a big move. And also, Fed officials and Federal Reserve officials actually moved up where they see inflation ending in 2025. In other words, they see not just inflationary pressures sticking around, but actually moving up. And we've seen that in PCE. So that's kind of the Fed's preferred measure of inflation. We've seen that bumping up since June. So up until June, kind of heading in the right direction, gliding down. But since then, really stuck far above the 2% target that Fed officials want. And so what that leaves the market with is completely repricing overnight, whether it was currencies in Asia or yields, as markets basically try to decipher what this means. Because remember, I mean, importantly, this is even before Trump enters office, and tariffs and the potential kind of inflationary impact there.
Which is something that Chair Powell had to address given the questions coming from reporters.
Yeah, reporters were very curious, and he kind of reiterated what he said before, which is that they haven't started to integrate it into their decisions for monetary policy. But importantly, you did see a few officials in making the dot plot kind of start thinking about what tariffs could do to inflation. So maybe not contributing to the Federal Reserve cut that we saw, but it's definitely something in the back of their minds. And the reality is, and this is what Powell reiterated, because he's said this before in press conferences, is that officials just don't know. Because Trump is not yet president, and they haven't seen what the shape of these policies might look like, let alone the order. Is it China first and then other countries? Will there even be tariffs potentially in the first half or second half of the year? So these are all open questions, and something that not just the Fed will need to consider, but also in China and Asia here, as central banks, I mean, after the decision today from the Fed, might have less room to cut.
Given that uncertainty, do we have any idea when the next rate cut could come?
It's really hard to say. Right now, there are expectations, given the dot plot, that there will be 2 more cuts. They probably want to wait, given how cautious and how much market volatility there's been. They probably want to wait until after the inauguration. We've heard from Trump that day one, there will be tariffs. And so at least until the February meeting, we could see officials kind of staying on hold, at least for now.
Katya Dimitrieva, good to have you with us, Bloomberg Asia economics correspondent there, with what to expect from the Fed. And it really is more uncertainty that's moving the markets at this point. Take a look at how futures and treasuries are trading, because we had really yields gaining ground in the overnight session, especially with the 2-year yield, which is more sensitive, of course, to rate moves. But they surged, the 10-year rate also rising to levels last seen back in May. And you can see futures at the moment pointing upwards. The Nasdaq 100 under a little bit of pressure at the moment, and this, of course, after we had the S&P 500 seeing the worst Fed day since 2001 and even falling below that 6,000 level. The magnitude of the losses really accelerating with the Fed decision, not to mention, of course, that signaling of what's to come in 2025. The Nasdaq 100 dropping also the most in about 5 months. We'll continue to watch the markets across Asia as well. We continue to see the downside pressure when it comes to the equity space. We have plenty more ahead with Japanese equity markets coming back online shortly. This is Bloomberg. Welcome back. You're watching Insight. We're watching the markets right now as they're coming back online after the lunch break. And Avril, we had seen significant weakness this morning as well. 5 sessions of losses. What are we seeing right now?
Yeah, we're seeing the region's benchmark at the lowest level since September, tracking those Wall Street performance. And this is a day where all the sectors are down, led by declines in infotech. It's really the region's benchmark showing these really bearish signals. Look at how it's broken below the 200-day moving average. And of course, this is on the back of that hawkish Fed cut and that cautious signal of what we might actually see in terms of rate reductions next year, just 2, right? But that's also impacting the FX space in Asia with the offshore yuan, I think popped above the 730 level against the greenback. And, it's really putting these Asia central banks in defense mode. The PBOC today stepping up the support via the fix, strongest versus estimate since July. Meantime, take a look at how Japan markets are coming back from the lunch break, still looking pretty weak, but pairing declines a little bit. 0.6% down on the Nikkei, topics on the back foot as well. This is mirroring what we're seeing in the rest of Asia. Of course, these losses. Dollar yen at 155.27. Sherry?
Avril, thanks for that. Let's get more on the markets with Bloomberg M Live Executive Editor Mark Cutmore. Mark, are the market gyrations right now justified after the Fed and the BOJ decision?
You wouldn't think it on the superficial level in terms of that everyone expected this to be a hawkish cut from the Fed. Yes, they did out-hawk those expectations. The fact that only 2 cuts in the dot plot for next year, the fact there was 1 dissenter from the cut this month did sound a little bit more hawkish. They raised their inflation expectations. So yes, it was even a little bit more hawkish than expected. But the scale of response has been really quite remarkable. I mean, US stocks having an absolute terrible day, their worst day since the August 5th sell-off this year that sparked a brief kind of panic for a couple of weeks. We see a large move in the dollar. Obviously, emerging markets are really getting crucified. So I think the direction of the response makes sense. I think the scale of the response is only justified in context of the positioning that was there, the complacency was there. The news wasn't enough to justify it alone. But you know what? US stocks were super expensive. They have just been going completely one way, oblivious to the news. And that's why I think you got such an outsized reaction overnight.
Right now, we're seeing a breaking headline. The Indian rupee weakening past that 85 per dollar to a record low. And we have seen those new records set around Asian currencies, right? The Korean won also touching that 2009 low. Given the strength of the US dollar, the Japanese yen continuing to weaken. Is this a trend that we might continue to see into 2025, given the gradual approach that we're expecting from the Fed?
I think we will see a little bit more dollar strength because it's going to be hard to kind of fight that trend now. I am in the camp that 2025 actually sees a turn in the dollar story. I think that a lot of the dynamics around what's happening in the US aren't necessarily as dollar positive as is priced. And I think when you talk about what's happening in the weakness in the Asian currencies, it's important to remember that from an investor point of view, on a total return basis, the Indian rupee tends to be a good investment. You get enough yield and it's a very stable currency. So yes, it's weakening, but we're talking about a very small scale of weakness. It is a low vol currency, and given the yield you get over time, investors who have been long India for most of this year have done well against most other currencies in the world, and I think they're even still positive against the dollar on a total return basis. It's completely different for the yen, where you both have negative carry in the yen and it's suffering on a spot basis. So in terms, I think there's still a lot of opportunity for relative value trading in Asia and not just traded as a one-way story versus the dollar.
And Mark, before we let you go, of course, we're watching the U.S. and a potential shutdown as early as Saturday when it comes to partial government shutdown. How could this complicate matters for the Federal Reserve and just a broader economy if we continue to see these political wranglings even before Trump goes into office?
Yeah, no one seems to care about the story. I think they should. I think it matters more than people think. So the general view is that there's government shutdown fatigue. We've kind of rerun this story before. There's always compromise. It doesn't really matter. Nothing ever drastic happens. So people have learned, it's like the boy who called wolf. They've learned to not really care too much about this story. And they think it's about gamesmanship and that there'll be a deal reached in the new year. It's only a partial shutdown. So markets are pretty complacent about this right now. I think there's a couple of worries. I think one is that the fact that this was derailed at the last moment, putting the Republican House Speaker in such a vulnerable spot, derailed via a couple of tweets at the last moment by Elon Musk, and the new DOJ committee shows how policy is going to be made now. And I think that is a worrying thing for investors. And it also implies that the era of balance and compromise in US politics it seems to be eroding. And therefore, it might reflect the fact that it's going to be more difficult to make decisions in the future. There's a chance for last-minute swivels. And I think that all these things are negative negative for stocks. They're negative for the US dollar. So no one really cares about the story right now because of the Fed, which was a big news story. We've got the BOJ. We got Christmas holidays and Christmas shopping to distract people. There are a lot of other things going on right now. But I think this will be a market story that people are going to be talking about into 2025, and they should be paying more attention, not just about what happens, but how the whole decision process has played out.
Yeah, and we thought we were going to be winding down for year-end, right? Happy holidays, Mark Cutmore, Bloomberg MLive executive editor. They're joining us from Singapore. And, of course, we continue to have a conversation with Jesper Koll, who's sitting right next to me, expert director, Monex Group. We're talking about the gyrations and the uncertainty coming from the Trump administration. Happy holidays. Deja vu, back to 2016, 2017, and the implications for Japan?
I think that it's not quite deja vu in the sense of that, in my personal opinion, the first time around, Trump had this Yujin Naikaku, as they say in Japanese. There's just a cabinet of friends, Now it's a real team, and they're all super professional. What they bring to the table. And I think most importantly, they know exactly what they want to do. And I think it's going to be pedal to the metal in terms of policy announcements. Yes, right now, you've obviously got this transition period. But the moment they're in power, I think there will be an avalanche of announcements. And, it's going to be both on the regulatory side, lots of deregulation agendas, but also on the global macroeconomic side. And I think, Japan needs to watch out a little bit, in the sense of that, yes, wait and see is the natural instinct of Japanese policymakers. But at the end of the day, you're going to have to show Donald Trump, you're going to have to show Scott Bessent that Japan is actually prepared to pull up its sleeve and do things by themselves.
I was very surprised in that sort of first conversations we had from Bloomberg, our reporters talking to Donald Trump directly. Yeah. And one of the first things that he mentioned out of the gate was the weakness of the Japanese yen. And he has that view, right? I mean, yen weakness means unfair trading practices. How could this really derail the relationship between Tokyo and Washington? And just because, as Mark mentioned, we could get another administration by tweet or by Truth Social posts.
Yeah. Tweet, Truth Social, whatever the pipe of communication is. But I think that, Japan is in focus. Japan is in play. What have you done for me lately? And, the reality of thank you, the Japanese economy is supposedly doing well. The reality of, objectively speaking, record amounts of deals done here in Japan, whether it's on the MBO side, management buyout, whether it's on M&A side, whether it's domestic capital formation. I mean, as you know, business investment spending here in Japan has been one of the strongest in the OECD for 3 years running. We haven't seen this in 40 years. So basically, I think the Trump administration will look at this and sort of saying, well, look, if things are so good in your own domestic economy, why do you need such super low interest rates? Please raise interest rates because we, the United States, actually does want to have a weaker dollar against the yen.
And you mentioned earlier how SoftBank was getting ahead with Masayoshi Son investing in the United States. I mean, Japanese companies are trying to. Nippon Steel wants to take over U.S. Steel, but that has become a hot political potato.
This is interesting. I actually think, and I bet you a bottle of champagne, that the deal is going to go. I think that it's a complete win-win situation. I think that the executives of Nippon Steel upping the commitment that they will invest in new factories to be built in the United States. Currently, it's about $1.2 billion, right? Upping that to about $2.5 billion, creating another 6,000 jobs. And Trump can stand in front of, his voters and say, hey, look what I've done. I just created, another another 10,000 jobs from our partners from Japan, actually giving us, right, great access to the latest technology in how to make specialized steel.
What are the implications, though, of more money flowing overseas instead of staying in the country, instead of staying and investing domestically?
No, it's not. It's interesting, right? Everybody always says, it's a zero-sum game. Well, it's not. It's like, the Japanese asset portfolio is actually growing. Right? You see Nippon Life, you see, Japanese corporations reaping in record profits. As a result of that, my firepower to invest in the United States, to invest elsewhere in the world is actually growing. So people are always saying, oh my God, if Japan becomes intractive, if the Bank of Japan were to increase interest rates higher, then Nippon Life or the Japanese insurance companies are no longer going to buy treasuries. That's not how it works. Because, as the Japanese yield curve steepens, right, what happens is that the insurance companies and the Japanese banks and Japanese investors make more money at home in risk-free assets. As a result of that, their ability to take risk in the United States or elsewhere in the world actually grows. So it's the steepness of the curve that actually matters, and the steeper the curve in Japan, the greater the ability and willingness to take risk in the rest of the world.
We are seeing that corporate activity being pretty, I'm not quite sure if I want to say risk-taking sentiment right now, but we are seeing more activity, even domestically, the Honda-Nissan potential merger. What do you make of that? Why are you smirking right now?
Why I'm smirky is because you are so nice, and you lived in Japan 10 years ago, right? Compared to the last 30 years, what has happened in Japanese boardrooms over the last 18 months is unprecedented. I mean, it may seem lame or normal by American standards, but oh my God, the president of CEO announcing the end of seniority-based compensation, introducing pay for commons. That is revolutionary in Japan. The, 7&I, right? The nicest consumer experience in the world is going to a 7-Eleven convenience store.
To be fair, only in Japan, not so much in the U.S.
Look, we are in Japan. All we care about is Japan. It's the best egg sandwich in the world, and every year that best sandwich gets a little bit better, right? So 7&I being, not just under attack from activist investors who want to get rid of lazy balance sheets, but actually a Canadian operator wanting to buy the business.
Wait, but that is, there's the other side of that story as well, right? The Ito family still wants to keep it within Japan.
Thank you, but this is fantastic. This is exactly right. You've got a takeover bid, right? Then you've got another bid, right? Whatever the price is being paid, we can argue about that. But the reality that now I've got metabolism, I've got Q&A, I've got a dialectics, I've got, oh my God, a market for corporate control. Unthinkable in the past. Corporate Japan was corporate Japan, and that's it. Now I've got a market for corporate control. And you know what? The Japanese elite, the Ministry of Finance, the financial authorities, the Tokyo Stock Exchange, all of them are endorsing it.
Wait, didn't they say that it was a key company in a key sector for national security?
But that is correct, and it is true that there is an argument that since Japan does have lots of earthquakes and does unfortunately have a lot of, tsunami, that, the supply chain of actually having a 7-Eleven, the ability to deliver food, et cetera, is important. But, that does not, deter, right, the takeover bids and the market coming through. Let me put it this way. You and I looked at Japan, and Japan was always this value trap, right? Lazy balance sheets, lazy corporate managers. Now Japan is waking up, and it is the global activists, it is global operators, and thank you if it's the Ito family coming back and saying, well, actually, that's our company, and we can run this better. Great! This is exactly what is needed. Japan is becoming unfrozen.
As long as the conversations are happening, as long as that debate is happening. Jesper Koll, always the eternal Japan optimist, but great to have you with us. He's the expert director at Monex Group, of course, digesting the BOJ decision and, of course, what's happening in the broader economy as well. Still ahead, though, we head to India. Fintech company Mobikwik delivers a stellar trading debut. CFO Upasana Taka joins us next to give us the Indian fintech outlook as well. This is Bloomberg. Welcome back. Let's bring in Avril in Singapore with a look at Indian markets. And Avril, big moves, especially with the rupee dropping to a record low.
Yeah, the Fed's really put these Asia central banks on defense mode, right? So the rupee, all-time low, as you just mentioned, but it's also worth noting that it's not the worst performer in the Asia-Pacific this year. I mean, even though it's at record lows, the worst performers include the South Korean won, the yen. We're also seeing the rupiah and the Thai baht among those that are not performing as well in the region this year. Worth noting that the RBI has been taking some deferring steps when it comes to defense of the rupee, whether it's offshore, onshore contracts, and looking as well at what we're seeing as stock markets in India open. The Sensex declining 1.2%, declines quite steep as well on the Nifty. This is an extension of the losses of the past 3 sessions as investors were engaging in some profit taking following a rebound earlier in the month. So these declines, again, mirroring what we're seeing in the rest of the Asia Pacific following the Fed's hawkish rate cut. Sherry?
Avril, yeah, we do have one company that's soaring at the moment as well. Indian payments company One Mobikwik Systems, soaring on debut in Mumbai, continues to gain ground today despite the downside regionally. Joining us now is Chairperson and CFO Upasana Taka. Great to have you with us, Upasana. So we, first of all, congratulations on the listing, on the trading debut. What do you hope to achieve after now that you've gone through this huge market hurdle? What are your expectations for 2025 in terms of how you expect to conduct business?
Firstly, thank you so much for having me here. Good morning to everyone. Yes, indeed, I think it has been a difficult, uphill task getting the IPO done. As you know, fintech IPOs in India aren't too many that have happened. So it has been an extremely challenging process. It has taken 1 full year to complete this. But, we have received amazing, interest from the investors, both Indian as well as foreign investors. And we are truly humbled and, excited by the response that we are receiving and the trust that people have bestowed in us. Where we go from here, see, the entire IPO was a raise of fresh capital for the growth of the company. So we will be, investing in our foundation business, which is payments, where we have 160 million users and 4.3 million merchants. So we will indeed try to bring Mobikwik to more and more households, cities and towns of India and solve their payment problems. In addition to payments, we also do distribution of financial products, whether it is credit products or investment products or even insurance products to both our consumers and the small merchants. So both of these business, we will be growing these businesses. We will be expanding with new products. And a good chunk of capital will also get invested in data, machine learning, AI, product and engineering, which happens to be the core DNA of the company. So yeah, I think we've grown 59% in the financial year 24 in terms of the revenue. And we also posted a profit. It's a small profit of $2 million US. So we expect to grow in the same range for the next several years. And we hope and aspire to be, profitable.
What sort of numbers can you put on the profit growth for the next couple of quarters, Upasana? And how might that sort of take into account the competition that you're also facing in the payment space?
So, April, competition has always been there. As we know, FinTech India is a very large market opportunity. And so, of course, there are 2 large global players in the market. Last 10 years, 15 years, we've been building Mobikwik. Despite the intense competition and despite the billions of dollars most of our competitors have raised and put into marketing. So I think competition doesn't faze me because the TAM is extremely large in India. And just like there are several banks, several NBFCs, several insurance companies, there will be several payment fintechs also in India. This year, Mobikwik has become the largest wallet player in India in terms of the total GTV or gross transaction value published on the RBI website. We intend to build up on our leadership position as the largest wallet. This year, wallet has also become interoperable on UPI. UPI, as you know, is the largest payment method in India digitally, where people scan the QR code and pay directly from their bank account. I think you guys will be excited to know that wallet is now interoperable on UPI. So Mobikwik users are now able to scan the UPI QR and pay anywhere. So we will be focusing on growth in these areas.
Can you charge fees on the UPI transactions? Like how does that work in terms of you making money?
Yeah, absolutely. So wallet transactions over UPI, as mandated by the Reserve Bank of India, already have an MDR, or a merchant discount rate, which is already published. And so, this is the small pie of the overall UPI piece. But this will be a piece where there is already MDR. I believe it is in the range of 1% that becomes available to us starting January of 25.
Upasana, just very quickly, given the proceeds that have been raised, I think you've previously alluded to how this is going to be towards data, AI spending. How different would that make things look for the consumer as well as merchants?
So, Avril, there are two things. First is that so far Mobikwik has built a payments franchise for the last 15 years. So that continues to be the way by which we acquire users. We acquired about 5 million users in the first quarter of June. So roughly 20 million users we'll acquire for the full year. Similarly, we acquire, 200,000 new merchants in the quarter of June. So what happens is, as we are acquiring these users and merchants, we can see a lot of their data, right? They do a full KYC with us. We see their spend data, whether it is payment acceptance or making payments. And based on that data and everything we understand about these users of ours, we try to profile them as to what might be the financial product they need. And then we tie up with the banks to bring them those products in a very easy manner. So a lot of this data is very important for recommending the right products to them, for underwriting in case of credit products, etc. I'll give you a very simple example. Mobikwik has come up with an innovative product called Lens.ai, where users can connect all their bank statements. Right. And they can just ask any question about their own spends and say, how much money have I made on the investments I have done? How much did I spend on travel in the last 6 months? And there's a chatbot layer we have built, which gives them the reply. This is a free personal finance tool that we are offering to all our customers.
Upasana, great to have you with us. We'll have to leave it here. Upasana Taka, Chairperson CFO at One Mobikwik Systems, and Avril Hong, of course, in Singapore. As we continue to watch the markets, we are getting some lines from the National Pension Service in South Korea saying that the NPS and the Bank of Korea will sign a deal to expand and extend their currency swaps. Of course, the Korean won has fallen to that 2009 low. And before, we had seen this comments around these FX swaps really moving the markets and supporting the currency at a time when we continue to see the downside pressure because of a strong U.S. dollar and, of course, the Japanese yen also under pressure, with the Bank of Japan holding steady. That's it for Insight. Horizons Middle East and Africa is next.